Welcome to this Nadex Bull Spread Master Series, Timeframes and Ranges. During this brief video tutorial, we're going to be discussing the various timeframes and various ranges of Nadex Bull Spreads. This is a very important concept to understand as these timeframes and ranges can work together for future strategies, risk-reward relationships, and what we'll cover in the next video, effective leverage. So with bull spreads, as we understand, there's a floor and a ceiling. And within each instrument, whether it be an equity index, a currency, or a commodity future, there are multiple time frames throughout the day, both daily, intraday of different durations, as well as ranges available for each underlying market. So here's an example of the Euro USD, which is the spot Euro USD pair. There are daily with a range of 600, number of contracts 1, Sunday through Friday. This information is available on the Nadex website. So you can look up whatever market you're trading and find out the number of contracts, the range, and how many are produced throughout the day. As you can see, there's an extensive list every day of various timeframes and ranges. So for example, the Euro USD 2 hour has a 100 pip range. And there are 3 contracts made on each of those expiration time frames. So let's take a look at how these work together. So using the Euro USD, there's one daily spread contract of 600 pips. So each day there's one made at 6 p.m. starting on Sunday, going through Thursday, and then the final one expiring at 3 p.m. on Friday. Here we see 600 pips. So to give you kind of an idea behind the concept, the market midpoint, roughly, is where this contract will start out. So we have a midpoint of 130 on the Euro USD. The floor will be 300 pips lower, and the ceiling will be 300 pips higher than that midpoint. We see for the 5 and 8 hour spreads on the Euro USD, they have a range of 250 pips. Now, at each interval, there are 3 new contracts made, and starting again at the midpoint. So if these were made at the start of the daily we just looked at with a midpoint of 130, we'd move 125 pips higher and 125 pips lower than the midpoint. Then we'd also have another spread with a floor of 130, ceiling of 132.50, and a third with a ceiling that is common with the floor in the previous, again a 250 pip range. Also on a 2 hour expiration basis made every hour, 3 overlapping spreads of 100 pips each. So let's take a look at how these might look together. So the daily range is in yellow, the 8 hour range is in blue, and the 2 hour range is in orange. And these will be running concurrently. And so we can see multiple floors, multiple ceilings. What this means is that there are multiple opportunities, whether our bias is long or short. If we prefer for risk control to buy near a floor and sell near a ceiling, then we'll have multiple opportunities at various time frames. And again, because these are made at various times, this may be how the market looks at 8 a.m. Still trading right in the center of that daily range, a new 8 hour contract is made, as well as new 2 hour. 1 hour later, if the market moves up, we've still got the previous ranges established. However, we've now made new levels for the shorter duration 2 hour. So as the market moves, these new contracts coming in will give us additional opportunity because we can keep common floors and common ceilings very near where the market is trading. So we can really look at our trading plan and manage our risk as we should on any instrument we're trading. Again, this was a brief tutorial of timeframes and ranges. I hope it was helpful. But for questions or additional information, please check us out at www.nadex.com. You can give us a call at 877-77-NADEX or email us customerservice@nadex.com.